Welcome back. This is module 5 of capital investment. In this module, we're covering capital, budgeting, cash flows, and this is the final lecture of this module. In this lecture, we'll learn how to find out terminal cash flow. In general, terminal cash flow is the cash flow that results from termination and liquidation of a project. Normally, it is at the end of a project's economic life. The terminal cash flow also represents the after-tax cash flow exclusive of operating cash inflows that will occur in the final year of a project. The proceeds from the new and old asset is also known as salvage value. So the salvage value represents the amount of net of any removal and cleanup costs expected upon termination of the project. If the net proceeds exceeds book value, a tax payment will be shown as an outflow, and if the net proceeds from the sale are less than book value, the tax rebate shown as a cash inflow. So here is the basic format for determining terminal cash flow. So first of all, after tax proceeds from sale of new assets, here you need to know proceeds from sale of new assets, then you have to plus or minus tax on sale of new assets. So to find out the tax on sale of new asset, first of all you have to find out accumulated depreciation on sale of for new assets. Then you have to find out book value of the new assets. Then using the book value, you'll find out gain on sale of new assets. Finally, on the gain, you have to calculate the tax. Then from the after tax proceeds from the sale of new asset, you have to deduct after tax proceeds from sale of old asset. So the process is same. First of all, you need to know proceeds from the sale of old assets. Then you have to plus or minus tax on sale of old assets. So finding out the tax on sale of old asset is same as the finding out the tax on sale of new assets. Then you have to adjust any change in net working capital, and finally you will get the terminal cash flow. So here is an example. The Powell Corporation is expected to liquidate the new machine at the end of its 5-year usable life for $50,000 after paying all removal and cleanup costs, and its old machine could be sold after 5 years for $10,000. And the firm also expects to recover its 17,000 net working capital investment upon termination of the project. So the net working capital will be added by 17,000. Here the first tax rate is 40%. Now here is the calculation of terminal cash flow for Powell Corporation. So the Powell Corporation is expecting to sell its new machine for $50,000. Its book value or its accumulated depreciation was $20,000, and the book value was like $30,000. So then we have to calculate the tax on the gain. Once again, its proceeds from sale of old machine was $50,000. That means the selling price of its new machine is $50,000. then the Pearl Corporation has to find out the tax on sale of the proposed machine. The gain on sale of the proposed machine or new machine after based on its accumulated depreciation is $30,000. Then the Pearl Corporation needs to pay tax on this $30,000. Tax rate is 40%. So tax is on sale of old machine is $12,000. Then the Pearl Corporation needs to deduct after tax proceeds from the sale of present machine or old machine. So proceeds from sale of present machine or old machine is $10,000 after all the cleanup cost and removal cost. Then tax on sale of present machine is $4,000. The book value of the present machine or old machine is 0. So the tax will be counted on this $10,000 for 40% on this $10,000. So that's the difference. The gain is simply the $10,000 as the book value of this present machine or old machine was 0. So the tax on proceeds on sale of the present machine is $4,000. That's 10,000 into 40%, $4,000. So total after tax proceeds from the sale of present or old machine is $6,000. So we have already know that the firm is also recovering a net working capital of $70,000. So net working capital will be added by $70,000. So based on this, terminal cash flow for Pearl Corporation is $49,000. Let's summarize the relevant cash flows. The initial investment, operating cash inflows, and terminal cash flow together represent a project's relevant cash flows. So these cash flows can be viewed as the incremental after tax cash flows attributed to the proposed project, and they also represent how much better or worse of the firm will be if it chooses to implement the proposal. So here is the relevant cash flows for Pearl Corporation. Its initial investment is $221,160. Then over the next 5 years, these are its operating cash flows. Its terminal cash flow of the Pearl Corporation's terminal cash flow is $49,000. So total cash flow in year 5 is $122,200. That's all about this lecture, and this is the end of module 5. In module 6, we'll cover risks in capital budget.